makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Joe Biden and Xi Jinping agree to restore high-level military communications as the Chinese president says Beijing wants peaceful ties with the U.S. With emerging signs of a softening labor market in the U.S. and sagging consumer confidence, we're also joined by Jim Bianco to discuss rates at a 22-year high and why he's bearish on bonds. And then on Bloomberg UK, our exclusive conversation with the Bank of England's Megan Green, her first TV interview since being appointed to the Monetary Policy Committee. So first thing is first, I'm really excited about our show coming up with our great guests, but we also need to look at what the markets are telling us. Now, for the moment, we're off the rally that we saw in the last couple of days. A little bit of a mixed picture. You can see the CAC 40 down 0.1%, the FTSE MIB and the DAX over in Germany and Milan, respectively, gaining 0.3%. Now, the euphoria over this potential pivot by central banks seems to be, of course, fading. A lot of the focus will be on data out of the U.S. later, and then the latest corporate earnings, but also possible deals. So back to geopolitics, and U.S. President Joe Biden has described talks with China's Xi Jinping as the most constructive and productive they've had yet. Now, President Xi says China is ready to be a partner, and of course a partner to the United States, but the positive tone was also overshadowed by a comment that the U.S. president made to reporters.
And Mr. President, after today, would you still refer to President Xi as a dictator? This is a term that you used earlier this year.
Well, look, he is. I mean, he's a dictator in the sense that he is a guy who runs a country that is a communist country that's based on a form of government totally different than ours.
So that's the geopolitics. Let's also bring in now Jim Bianco. He's founder and president of Bianco Research. Jim, first of all, I'm so excited to see you in London. Thank you also for all the great chart analysis that you send us on a weekly basis. Where are we now? So there's the economy is holding up, but there are signs to the downside, and then the market is doing something else.
Yeah, I think the real question is are we going to have a slowdown or a soft landing or a recession? That has been the call for the last 18 months, and it has largely not come to pass. And I guess the question we have to ask is, why does the economy, to use Jay Powell's phrase, surprisingly resilient? Right. And I think the answer is consumer spending. The consumer continues to spend. Why does the consumer spend? I think we don't appreciate what happened in 2020. With the shutdown restart of the economy, people have a different attitude about jobs. They're more transactional about jobs. They feel like they can quit their job, they can get another job, so they're very comfortable with spending. I don't have to worry about being unemployed for a lengthy period of time. If I self-unemploy, if I decide to quit, I can get another job. So spending keeps coming and coming and coming, and the economy continues to stay resilient. And until about 2 weeks ago, the bond market was responding by ever higher interest rates to that.
But so first of all, if we take a step back, is this on credit card or is this also money pent up during COVID where we didn't go out so much? Because if that's the case, then at some point it kind of dries out.
Yes, it's a little bit of both. I mean, we're still struggling to figure out how much post-pandemic excess savings we still have. Yeah. And most of the new research coming out is suggesting that there's a little bit more than we have. And there has been an uptick in credit card spending, but I think really, it comes down to an aggressiveness by consumers that they are willing to spend revenge travel or whatever phrase we want to use because they're not concerned, at least at this point, that they're going to lose their job and that they're going to have to retrench.
Jim, I know you sent some great charts. We got one made actually looking at expectations for GDP in the third quarter of 2023 compared to what we're expecting for 2024. Now, what's interesting to me, Jim, is actually if you look at expectations, I mean, even in the last 12 months, they've been all over the place. I mean, we're expecting a recession. You know, we have all these like mountain tabletop also kind of analysis.
Yes.
Like, how are you so sure that it doesn't get really ugly from here?
Well, what you've been seeing is this repeating pattern, because what the chart just shows is Q4 and Q1, that the expectations for GDP are being revised up and up and up. Yeah. This is maybe the sixth or seventh quarter in a row that this exact pattern has been happening. Right. When we look at the economy, out 6 months, we say contraction, possibly recession, and then in 6 months, it never happens, right. And then it's contraction, possibly recession, and it continues and it continues. And I don't see anything yet on the horizon that suggests that that pattern should change. The stock market's not down. I don't believe interest rates, even at 4.5% on the U.S. 10-year note, are at injurious levels for the economy. There's nothing that has yet broken, the old line that, you know, something breaks for the economy. That hasn't happened.
Yeah.
We survived the banking crisis of the spring.
Okay, so if something breaks, where do you see it first? Because it is also odd, right? This is like CFA level 4, that you go from like 0.05 interest rates to 5% without anything breaking.
Yeah, it is, but you also have to remember that the 2009 to 2020 period was the abnormal period. That was QE. That was not only depress interest rates to 0, but in Europe and in Japan, take them to negative. So some of that 500 basis point rise, or maybe a majority of it, was just correcting the QE period, because we're not in a QE period. We're in a QT period. So some of that interest rate rise has probably been restrictive, but not nearly as much. What tells you something's broken? Historically, risk markets usually have a bad reaction, a very bad reaction to whenever you break something. They're not having a bad reaction. Neither credit is or equities.
So, Jim, what do you expect to happen for maybe the markets to shift actually on treasuries or bonds in general?
I've been bearish on bonds for a couple of years. I believe the 40-year bull market ended in August of 2020, so we're in year 4 of a bear market. We've had a relentless rise of rates until about 2 weeks ago. I see this as a natural correction in that longer uptrend. This could still run another several weeks, this kind of sideways to lower yields. But ultimately, I think we're going to make new higher yields in the first half of 2024. And probably around 5.5% to 6% is at least now where I put the fair value for the U.S. 10-year. So it's got another 100 basis points to go. And my concern is the Federal Reserve is not raising rates because they say financial conditions will do the work for them. Well, that starts at 5.5% in the way that I look at it. The markets haven't begun that move yet. And then it could be potentially higher interest rates even from there. That's if necessary. So I do, think that rates are going to continue to move up.
Yeah, and so what does that mean for the economy? Again, and we've seen a dispersion in credit. Does that just get worse?
Well, eventually you will get to that point where you get high enough that you will see a serious retrenchment in the economy. I don't think we're at that level here yet. But if you put rates at 5.5, you put mortgage rates in the U.S. pushing 8.5 or 9, they're about 7 3/4 right now. You might start to see even more retrenchment in the economy. You might then start to really open that discussion that the Fed hikes or rates go up until something breaks. We're not there yet. So that's why I think we have to go higher.
Jim, is China the big unknown? I mean, we're expecting it to be inflationary when it reopened. We haven't really seen that because there are so many question marks about their economy.
China is a huge unknown. We thought after zero COVID that there was going to be a boom in China. And in the first quarter, everybody positioned for it, and it never really materialized. So, yes, it has been somewhat of both on an economic front with its disappointment and on a political front, because we've seen a lot of companies, Google with their Pixel phone moving to India as one example of companies that I think are telling us there's too much political risk right now to stay in China. So, yes, they do remain a giant wild card right now.
Jim, when it comes to financial conditions tightening, is there something that we're measuring wrong, or is it just that it basically takes longer time for interest rates to take effect?
I think what we're measuring wrong is what is the fair value of interest rates. The Federal Reserve, to use the Federal Reserve's measure, they think it's a 2% inflation rate plus 0.5% on top of that, which is what they refer to R star. I think that the inflation rate is more like 3.5, and that 50 basis points or 0.5% on top of that, given higher interest rates, more volatility, might be closer to 1%, so that the fair value might be closer to 4.5. Now, we're above that level, but that doesn't mean we have 300 basis points of restrictiveness, maybe 100 to 150, and that's why the economy is able to withstand that type of restrictiveness and why rates have to go higher.
Jim, thank you so much. So fun having you in London. Jim Bianco, their founder and president of Bianco Research. Now, coming up, Larry Fink and Tim Cook among the top executives to bag a seat at an exclusive dinner with the Chinese President Xi Jinping. We'll discuss the politics next. This is Bloomberg. Now, relations between the U.S. and China have thawed somewhat following a summit between Presidents Joe Biden and Xi Jinping in San Francisco. Well, President Biden described their talks as some of the most productive and constructive yet, although he did maintain that Xi Jinping is a dictator when asked by a reporter. Now, for his part, President Xi said he was ready to be a partner and a friend to the U.S.
China never bets against the United States and never interferes in its internal affairs. China has no intention to challenge the United States or to unseat it. Instead, we will be glad to see a confident, open, ever-growing, and prosperous United States. Likewise, the United States should not bet against China or interfere in China's internal affairs.
Now let's bring in Bloomberg's Rebecca Chun-Wilkins. Rebecca, has anything firm actually been agreed in San Francisco?
Well, I think for the US, there are these hard wins that Biden can walk away with. This agreement on fentanyl, the military talks, the resumption there as well, and potentially this dialogue in AI. Although it sounds all a little bit airy-fairy, at least gives Biden the illusion of walking away with something from Beijing. But I think for Xi, the biggest win here is having this opportunity to shift the narrative. And he really has come across as somewhat kind of friendlier and warmer than I think, many in hawks in Washington were perhaps expecting. Particularly this speech that he gave to business executives at dinner, and seeing kind of so many high-profile US businesses keen to sit at that top table with Xi himself. He touched on this idea of panda diplomacy returning, and again reassuring the US, I think in the clearest terms I've heard in quite some time, that it doesn't have any intention to engage in any kind of hot conflict. And some of those comments were reiterated by Biden himself there. He really wasn't drawn on any questions over Taiwan, just reiterating the one China policy. And again, in the readout, we had that same emphasis that the US isn't planning to move away from that at all. And this Taiwan is that really big sticking point for Beijing. It's been very, very uncomfortable with rising scrutiny over its ambitions there, which of course has prompted its neighbours to ramp up spending and so on. So kind of, playing down the risks that China poses from that national security front has been really important. And it does seem that we have had some of that shift in narrative from both the US side and the China side.
Rebecca, thank you so much. Rebecca Chun-Wilkins there with the very latest on Biden and Xi. Now, coming up, a change at the top for Manchester United with a new chief executive and a widely expected new owner. So we'll discuss that with our guests. That's next. And this is Bloomberg. Manchester United Football Club has confirmed that its chief executive, Richard Arnold, is stepping down after 16 years. Now, it comes almost a year after the club's American owners, the Glazer brothers, announced they were looking for a fresh investment. Now, a Qatari offer to buy the club was withdrawn last month. That leaves the British billionaire Jim Ratcliffe, founder of Ineos, widely expected to take a 25% stake in United. So what does this all change mean for the club? Well, with me in the studio are Flex, a lifetime Man United supporter who founded the YouTube channel United View. Good morning. And John Yetimoglu, Chief Investment Officer at Infinitum Partners, who is a minority shareholder in Manchester United. Good morning to you. This is exciting to have you both to try and see the different perspectives. So, John, what do you think of the deal?
Well, look, first of all, I'm a big Man United fan and supporter. I respect the history of the club. But, for the sake of this interview, I'm just going to speak to, the semantics of the deal as a shareholder and not really as a fan. It's been one of the wildest, most bizarre takeover processes I've ever encountered as an investor. But it seems like something's coming to an end now.
Bizarre because there's a lot of emotion attached, and it's not only about the deal, or bizarre how?
Yeah, across all those fronts. There's been tons of strategic PR from all parties. You don't really know what to believe. It's just, one party looks like they're going to win, and then, the other party pulls ahead. So it's just been bizarre for that reason. Yeah.
Flex, what's your take?
It's been a very frustrating process from a fan's point of view. Fans feel like they haven't been well informed, as John just spoke about. One party would lead the race, then another party would lead the race, and fans feel like the Glazers haven't really been transparent during this process, which has led to a lot of uncertainty. I think that Manchester United fans would welcome the fact that there is change from the Glazer ownership. I feel like Manchester United fans understand that the Glazers have not run the football club to the best of its abilities and to the best that it can be. And with Richard Arnold stepping down, it is a welcome change at a structural level above the manager that needs to happen in terms of a whole restructure. And I think Manchester United fans will be very cautious with what's about to happen, but would embrace the small change or significant change that seem to be coming upon us.
John, if the offer is actually less than what the Qataris offered, I mean, should we block the deal?
Yeah, I mean, that would be a breach of fiduciary responsibility. We believe all shareholders need to be treated equally in pari passu. So can't favor one shareholder over the other, whether that be Class A or Class B.
But in terms of financial, so what are you looking in terms of financial? Does the deal, need to be as good as what the Qataris were putting on the table?
Yes, we believe that. I mean, for them to accept a deal lower than where the Qatari bid is, wherever that was, doesn't really make sense, right? A full takeover would have been what was ideal for fans, investors, and the club in general. But if you're going to do a protracted takeover, number one, the price has to be better. And then number two, there needs to be clarity given to both fans and shareholders on timing of when the remainder of the club is going to be purchased.
And I think John nails it right there, because if you're looking at how Manchester United is set up now, many Man United fans have felt that the Glazers have needed to leave the football club for a long time. The lack of investment into the infrastructure. You look at the training ground, you look at the playing squad, you look at the stadium, and there was an option there that was a world record bid for a full takeover, a full buyout, which is what every Manchester United fan, I believe, in my opinion, is behind. And for the Glazers to not accept that, like John says, it didn't make a lot of sense. And if Sir Jim Ratcliffe is coming in as a minority shareholder, which is yet to be confirmed, but we believe that to be true, and he's only going to have a 25% stake, but he's going to get sporting control, what's the roadmap? Is there going to be a full buyout by a certain time? Are the Glazers going to be bought out by a certain year? There's still so much that Manchester United fans that feel that they're in the dark about.
Yeah, so you both feel that basically this deal has been badly executed.
Absolutely.
And so who's to blame?
The Glazers, in my opinion, as a Manchester United fan. I think that the Glazers have shown that their main motivating factor, of course, is money. And if you are an owner of a football club, I understand that. Fans can understand that. We've seen many rich owners run football clubs correctly to the best of their ability, which, in my opinion, in turn, generates more revenue. I think if the Glazers were really interested in making Manchester United the best it could be, they would reap dividends from that. They would really see a surge in revenue. They would really see a successful football team and would be at the top of the football pyramid. Instead, I believe, personally as a Manchester United fan, they've allowed Manchester United to rot. I think they've allowed Manchester United to be poorly run, all in the name of course, their finances have been where they want it to be, and I think they've reached a point where they've realised that in order to take Manchester United forward, somebody else is going to have to put money forward, and that's why we're not seeing that full buyout. We're seeing a position where the Glazers are able to stay at the football club, and somebody else, i.e. Sir Jim Ratcliffe, is going to have to fork out his own money.
Do you agree with that?
Yeah, in a way. I also believe that Rain Group might have set expectations a little bit too high for the Glazer family when they were initially negotiating to be the advisor as a merchant bank. And look, I mean, Liverpool had just sold, and everyone was pretty excited about Premier League assets, and the market crapped out a little bit, and there was only two bidders. So, yeah, I mean, it's a bunch of factors, but obviously.
John, expectations were high. Was that because of Chelsea also, and how much that?
I mean, Chelsea. I meant to say
Chelsea,
Chelsea, not Liverpool. Yeah. Liverpool did take a minority investment, I think.
But it's Chelsea. Yeah. I mean, the takeover of Chelsea, did it kind of change expectations for owners? Full stop.
Absolutely, because Chelsea was essentially a fire sale, right? It was a forced sale, and for them to get a price that high, got other Premier League owners, and Manchester United is the marquee asset in the Premier League and probably the world as well.
Flex, in 20 seconds, your advice to Jim Ratcliffe if he has that 25% stake?
If Sir Jim Ratcliffe cares about Manchester United as much as he says he does, if he's a fan as much as he says he is, I understand he's a businessman, then take care of the football club, ensure that there is a full buyout and the Glazers are removed from the football club, and be transparent with fans. Let us know what the plan is and what the vision is.
John and Flex, thank you so much both for joining us. John, Yetimoglu and Flex. Coming up, it's her first TV interview since joining the Bank of England's Monetary Policy Committee. Our exclusive conversation with Megan Green. That's next, and this is Bloomberg.